welcome to this deep dive. If you follow the Talk Tickers format, you already know our mission here.
Right, we get straight to the point.
Exactly. We are data forward, we completely strip out all that corporate spin, and we give you an actionable, opinionated breakdown.
No jargon, just the facts and what they actually mean for your money.
You got it. And today, we are putting Morgan Stanley Direct Lending Fund under the microscope. That's ticker symbol MSDL. And wow, we really need to talk about the macro environment first because
it's been wild.
It really has. I mean, for 2 straight years, Wall Street's hottest private credit funds basically watched their lending power just bleed out. Borrowers were demanding cheaper and cheaper rates. It was borrowers' paradise.
Oh, completely. Lenders had almost no leverage.
Right. But Q1 of 2026 just triggered this massive reversal. We are talking about a structural shift in the power dynamic between the people who need capital and the people who actually provide it.
And that's what makes this specific deep dive so fascinating.
Exactly. We're going to figure out if this stock is a buy, a hold, or a sell. Because right now, the narrative out there is just full of panic. Panic about rate cuts, AI disrupting entire sectors, the looming wall of debt maturities. So we're going to see how MSDL's latest earnings call actually holds up against all that anxiety.
Yeah, and the contrast between that prevailing market anxiety and the actual operational math inside MSDL's Q1 print is, well, it's what makes this such a compelling case study.
A real-time stress test, basically.
Exactly. You're seeing a real-time stress test of the entire business development company model. I mean, you have a management team navigating some serious cross-currents right now.
Yeah, they're fighting the math of falling base interest rates, for one.
Right. Plus, they're managing a portfolio that's heavily weighted towards software.
Which is terrifying in the age of generative AI.
It is. And they're doing all of this while actively trying to maintain a premium yield for their shareholders. It's a very tightrope to walk.
Okay, so let's jump straight into the raw headline numbers.
Yeah.
We really have to establish the baseline financial health of this company before we start, dissecting their strategic moves.
Let's do it.
So I'm looking at the initial numbers that flashed across the screen for Q1 2026. And honestly, if I'm a retail investor just reading the headline ticker, I am immediately putting my guard up.
The optics definitely, they invite some really tough questions.
Yeah, because here is the raw feed. Net investment income, which is the absolute lifeblood of any BDC, came in at 47 cents per share.
Right.
And that is a noticeable step down from the 49 cents they posted in the prior quarter.
Yep, a 2-cent drop.
And then total investment income hit $89.1 million, which again, shrinking from the $96.6 million they had previously.
It's a significant haircut on the top line.
And it doesn't stop there. We also saw their net asset value, the NAV, drop to $19.81 per share. That's down from $20.26.
Which is what really spooks people.
Exactly. Now, they did declare a 45-cent dividend, which gives us some breathing room.
A little bit of a cushion, yeah.
Right. But the overarching trend on the top line is just contraction. Income is down. Asset value is down. So my immediate reaction is to ask, are we finally seeing the cracks of a rate cut cycle actually hitting these floating rate lenders?
I get why you'd ask that. But I would push back pretty hard on the idea of cracks in the foundation.
Really? Even with those numbers?
Yeah. I mean, the mechanics of your concern are totally valid, but we have to ruthlessly separate optical weakness from fundamental deterioration. They are not the same thing.
Okay, fair point.
Let's isolate that drop in net investment income first. That slide from 49 cents to 47 cents.
Let's do it.
When an income-focused investor sees a declining earnings print, the immediate fear is, oh no, borrowers are defaulting. The underwriting was flawed.
Right. You assume the loans are going bad.
Exactly. But we have to look at the structural architecture of a BDC like MSDL.
No.
Roughly 94% of their portfolio consists of first lien senior secured loans.
Top of the capital stack.
Top of the stack. And more importantly, for this specific quarter, these are overwhelmingly floating rate instruments.
Which means they are just directly tethered to the macroeconomic benchmark, right?
Exactly.
So if the Federal Reserve moves the base rate, the interest payments MSDL collects from its middle market borrowers just adjust mechanically.
You nailed it. It's not a negotiation with the borrower. It's literally a formula baked into the credit agreement.
Okay, so connect that to the Q1 numbers for us.
Right. So the Federal Reserve executed a rate cut in December of the previous year.
Oh, right. The December cut.
Exactly.
Yeah.
Because of the floating rate nature of MSDL's loan book, the cash flowing into their coffers automatically adjusted downward the second Q1 commenced.
Just simple math.
Just math. When CEO Michael O.C. addressed that drop in total investment income, that slide from $96.6 million down to $89.1 million, he explicitly pointed to the timing of that December rate cut.
Because the base rate fell.
Right. The base rate fell, so the top-line revenue fell. It is simply the mathematical reality of the environment. It is not a sudden spike in middle market distress or defaults.
Okay, I hear the structural defense there. I do. But look, a drop in top-line revenue is still a drop in top-line revenue.
Sure.
The water level of the river still went down. If less cash is coming in the door from borrower interest payments, that leaves less cash available to fund the dividend and just, run the operation.
You're right.
Because you can't pay your shareholders with a structural excuse, right? Yeah. You have to pay them with cold, hard cash.
Absolutely. And that brings us to the liability side of their balance sheet, which acts as this incredible built-in shock absorber.
Walk me through that.
So MSDL doesn't simply lend out equity. They utilize leverage. They borrow capital from larger institutional banks to finance their middle market lending.
Right.
And here is the kicker. A significant portion of MSDL's own debt is also floating rate.
Okay. I see where you're going with this.
Yeah, so yes, their total investment income dropped by roughly $7.5 million. But you have to look at the expense line. Total expenses contracted from $54.2 million in the previous quarter all the way down to $48.6 million in Q1.
Because their own cost of capital adjusted downward right alongside the rate cut.
Exactly.
So they're collecting less from their borrowers, but they're also actively paying less to their own creditors.
You got it. The spread between their cost of capital and their lending yield is what actually generates the net investment income.
Right.
So that reduction in interest expense materially softened the blow to the top line. When you net the reduced revenue against the reduced expenses, you land safely at that 47 cents of net investment income per share.
It really demonstrates the symmetrical nature of a floating rate balance sheet, doesn't it?
It's beautiful symmetry, honestly.
That symmetry is reassuring, I'll admit. But let's pressure test the dividend for a second, because they declared a payout of 45 cents per share.
Okay.
And for you, the retail investor sitting at home, the entire thesis of holding a BDC in your portfolio is the reliability of that quarterly check.
Exactly. You buy it for the income.
So if they earned 47 cents and they are paying out 45 cents, we're looking at a dividend coverage ratio of 104%.
Yep. And 104% coverage ratio in a quarter where they absorbed the full brunt of a macro rate cut. That is a testament to incredibly conservative capital management.
They aren't just like scraping the bottom of the barrel to maintain the payout.
Not at all. In fact, management actually telegraphed this exact dynamic back in February.
Oh, did they?
Yeah. They made a very deliberate adjustment to align their dividend payout with what they termed their forward earnings power in a normalized rate environment.
So they saw the Fed cuts coming.
They absolutely did.
They ran the stress tests on their floating rate book, and they set that 45-cent dividend at a level they knew they could comfortably clear, even if base rates stabilized at this new lower plateau.
Precisely. They essentially engineered a floor.
That's smart.
It really is. They removed the uncertainty for the income investor. By establishing a dividend level that is fully covered by the new lower baseline of NII, they transition the whole narrative.
From will they cut the dividend to what?
To how will they grow the buffer?
Okay, I am satisfied with the NII explanation.
Mm-hmm.
It's a mathematical certainty of the rate environment, and it's heavily mitigated by their own floating rate liabilities.
Right.
But we cannot ignore the second major red flag in those headline numbers.
The NAV.
The net asset value. Because a 45-cent drop in NAV, falling from $20.26 down to $19.81, that is substantial.
It's a big move.
It represents a real contraction in the underlying mark-to-market value of the loans on their books.
Yeah.
And if the physical assets you own are actively deteriorating in value, well, the strength of the dividend coverage ratio is just a temporary shield. Right?
Eventually, yeah.
Eventually, asset degradation eats the whole enterprise. So what happened there?
Okay, we have to unpack the anatomy of that 45-cent NAV decline. It's crucial. CFO David Pessa broke this down during the call.
What did he say?
He noted that they recorded $45 million in combined unrealized and realized losses for the first quarter.
Okay, $45 million.
But to understand the actual health of the portfolio, we absolutely must bifurcate that $45 million.
Right, so we need to separate the paper losses driven by market sentiment from the permanent losses driven by actual borrower failure.
Exactly. Let's address the paper losses first, because that's the bulk of it. Approximately 2/3 of that NAV decline was driven by unrealized losses stemming from spread widening.
Okay, let's dig into the mechanics of spread widening for a second.
Yeah.
Because it's a concept that often trips up even sophisticated investors when they look at BDC accounting.
It's very counterintuitive.
Because we aren't talking about the base rate moving anymore, right?
Yeah.
We are talking about the risk premium.
Yes. Think about the interest rate on a middle market loan as a 2-layer cake.
Okay, I like cake.
The bottom layer is the base rate, SOFR, right? That's driven by the Federal Reserve.
Got it.
The top layer of the cake is the spread. That's the specific percentage the lender demands to compensate for the credit risk of that particular borrower.
So if a borrower was deemed low risk a year ago, MSDL might have underwritten the loan with, say, a 4% spread over the base rate.
Right, exactly. But then the macroeconomic mood changes.
As it always does.
Right. The broader market looks at inflation or geopolitical instability or sector-specific headwinds, and suddenly the market demands a higher premium for taking on that exact same illiquidity and credit risk.
So investors decide that a 4% spread is just no longer sufficient.
Right. They want a 5% spread for that exact same risk profile today.
And that shift in market sentiment triggers strict mark-to-market accounting rules.
Yes, unfortunately for the optics, MSDL holds a seasoned loan paying a 4% spread, but the current market demands 5%.
So if MSDL were forced to liquidate that loan tomorrow, a rational buyer would demand a discount on the principal.
Exactly, to mathematically bridge the gap between the 4% the loan pays and the 5% the market currently demands.
Therefore, the accountants step in. They require MSDL to write down the carrying value of that asset on their balance sheet.
Yes, and it manifests as an unrealized loss, which drags down the NAV.
But here's the critical distinction for you listening at home. The borrower hasn't missed a single payment.
Not one.
The cash flow remains pristine. The business itself might be thriving. The markdown is purely a reflection of secondary market pricing dynamics, not underlying credit deterioration.
You hit the nail on the head. And management specifically called out that this spread widening was highly concentrated in their softer portfolio during Q1.
Which totally aligns with the broader market volatility we saw in enterprise tech valuations during that window.
Yeah, the market threw a huge premium on software risk, and MSDL's balance sheet had to absorb the accounting friction.
Okay, so I can safely compartmentalize that 2/3 of the NAV drop as temporary noise, just paper losses.
Purely paper.
But that leaves the remaining 1/3 of the $45 million. And that portion was driven by fundamental credit issues, specifically realized losses. They took a permanent hit on a specific company they refer to as 4840.
Right. And this is where we transition from accounting dynamics to actual underwriting performance.
Because a realized loss means the money is gone.
Taking a realized loss means the restructuring is entirely complete, the impairment is finalized, and yes, that capital is gone. The 4840 situation requires us to scrutinize their non-accrual metrics.
And for a portfolio heavily weighted in senior secured debt, non-accruals are basically the ultimate barometer of distress.
They are the absolute truth teller.
If a borrower breaches their covenants and ceases making scheduled interest payments, the loan stops accruing value. It hits the non-accrual list. It is the red flashing light on the dashboard.
Exactly. Now, what is genuinely remarkable about Q1 is the divergence between that optical drop in NAV we just talked about and the actual trajectory of their credit quality.
Walk us through those numbers.
Going into the first quarter, MSDL's non-accrual rate sat at 1.6%.
Okay.
But by the end of Q1, despite all the macro turbulence and the rate cuts, that non-accrual rate actually contracted to 1.5%.
Wait, really? That is a highly counterintuitive data point.
It is.
You have an environment where rates are still historically elevated, which puts immense pressure on middle market cash flows. Yet MSDL's default rate is actually shrinking.
It speaks to incredibly aggressive, proactive portfolio management.
They didn't just passively hold on to distressed paper?
No, they didn't. They removed 2 investments from non-accrual status during the quarter, and one of those was the 4840 resolution we just discussed.
So they recognized the reality of the situation.
Right. They restructured the capitalization, took the realized loss to clear the balance sheet, and neutralized the ongoing drag.
Taking your medicine early rather than letting a zombie company drain your resources for years.
Precisely. I mean, that aligns perfectly with best-in-class asset management.
So they cleaned house.
They did. Now, to be fair, they did have to add 3 new investments to the non-accrual list during the quarter.
Who were they?
Abercrombie Group Holdings, specialty dental brands, and KYR acquisition.
Okay, adding 3 new companies to non-accrual is not trivial.
No, it's not.
Because you have exposure to retail and consumer healthcare in there. Those are sectors that are highly sensitive to margin compression and honestly just consumer spending fatigue right now.
It highlights the reality that no underwriting is bulletproof, right? Especially in a prolonged period of elevated debt servicing costs.
Sure.
However, because they successfully resolved the 4840 situation and one other legacy issue, the mathematical netting of all that resulted in an overall improvement.
So dropping those bad loans offset the new ones.
Exactly. A 10 basis point drop in total non-accruals down to 1.5%. I mean, that is a fortress level metric in the current vintage of private credit.
I have to agree. If you look at the broader BDC space right now, seeing non-accruals creeping up past 3%, 4%, even 5% is becoming increasingly common.
Especially among the aggressive yield chasers.
Right. So MSDL sitting pretty at 1.5% suggests their initial underwriting on the front end was exceptionally tight.
Chief Investment Officer Ashwin Krishnan actually provided some broader context on the call that supports this exactly.
What did he say?
He noted that across their active borrower base, revenue and EBITDA growth rates remain incredibly healthy, and net leverage ratios actually experienced a modest decline during the quarter.
Oh, wow. So the companies they lend to are actually deleveraging.
Yes.
They are growing their earnings faster than they are accumulating debt.
Exactly. And that is the strongest defense against future non-accruals you could possibly ask for.
So to summarize the NAV story for the listener, the headline screams a 45-cent loss.
Right.
But the autopsy reveals that the vast majority was an accounting phantom driven by market spreads in software, while the actual physical credit health of the borrowers improved.
That is the analytical takeaway, yes. But we can't stop there. Management's response to that NAV drop is equally important.
What do?
They utilize the market's mispricing to actively manufacture value.
Ah, you were talking about their capital allocation strategy, specifically the share buybacks. I want to spend some real time on this because it's a brilliant mechanism when executed correctly, and it shows a level of discipline you really don't always see in asset managers.
No, usually they're just desperate to grow their fee base.
Exactly. So MSDL's stock was trading in the open market at a discount to its underlying net asset value. Let's frame that for the listener really quickly.
Sure.
The public stock market, in all its infinite emotional wisdom, was pricing MSDL shares at, say, $18.
Right.
But the actual accountants, looking at the rigorously audited value of the individual loans in the portfolio, calculated the true value at nearly $20 a share.
So when that dislocation occurs, management faces a choice. They can ignore it, or they can weaponize their own balance sheet to exploit the market's irrationality.
And MSDL chose the latter.
They absolutely did. They deployed $15 million to aggressively repurchase their own shares on the open market.
Think about the physics of this move for a second. They are basically buying $1 worth of assets for 90 cents. And when they retire those repurchased shares, the total number of outstanding shares shrinks,
leaving the remaining shareholders with a larger proportional slice of the total asset pool.
It is functionally equivalent to retiring debt at a massive discount. It results in an instantaneous transfer of equity value to the remaining shareholders.
And you take on zero new operational risk.
Zero underwriting risk.
And you synthetically create yield. It's beautiful. CFO David Pessa calculated that this $15 million repurchase program was directly accretive to the tune of roughly 5 cents per share in Q1 alone.
Wow. So it effectively neutralized a significant portion of the credit-driven NAV drop we discussed earlier.
It did. It is a highly defensive, highly accretive maneuver.
Okay, but it was their second strategic maneuver in Q1 that really requires our intense scrutiny.
The joint venture.
Yes, they launched the Capstone Lending joint venture.
The Capstone JV is arguably the most complex and structurally significant evolution of their balance sheet this entire year.
I am going to play the skeptic here for a minute.
Go for it.
Because whenever I see a BDC launch an off-balance sheet joint venture to boost yield, my financial engineering alarm bells start ringing really loudly.
As they should.
Let's look at the timeline. MSDL is facing a macro environment where Fed rate cuts are acting like a leaky bucket, draining their base interest income.
Right.
And suddenly, they just spin up this Capstone JV. They seed it with $94.5 million of MSDL's equity. And in a mere 5 weeks of operation during Q1, this JV generates an 11.2% yield.
It's a huge jump.
For context, their standard unlevered asset yield on the main balance sheet is 8.7%. So this entity added a full penny to their NII almost instantly.
The acceleration is incredibly impressive.
Honestly, it's too impressive. My concern here is structural subordination and hidden risk.
Okay, unpack that.
Are they taking a senior secured loan yielding 8.7%, shoving it into a special purpose vehicle, piling on massive leverage, and just masking the true risk profile from the retail investor?
That's the classic fear with JVs, yeah.
In a severe credit event, who eats the first loss in this JV structure? Is this just a fancy trick to juice the dividend coverage?
Your skepticism is totally warranted because JVs have historically been used by lesser funds to hide toxic mezzanine debt or, equity co-investments.
Exactly.
But we must analyze the specific mechanical architecture of the Capstone JV. It is not designed to mask toxic assets at all. It is designed to optimize regulatory capital constraints.
Okay, explain that regulatory constraint for us.
By law, business development companies operate under strict statutory leverage limits. Generally, a BDC cannot exceed a debt-to-equity ratio of 2-to-1.
Meaning for every single dollar of pure shareholder equity they hold, they are legally capped at borrowing $2 against it.
Right.
And that regulation exists for a very good reason. It prevents catastrophic implosions during liquidity crunches.
Absolutely. And MSDL historically runs a highly conservative balance sheet. They operate well below that legal limit, typically hovering around a 1.22 times debt-to-equity ratio.
They prioritize safety.
They do. However, this creates an efficiency drag.
How so?
Well, if MSDL holds a tranche of incredibly safe, senior secured first-line loans, I'm talking assets with pristine collateral and massive equity cushions.
Right.
Borrowing only 1.22 times against those specific assets is mathematically inefficient.
I see. They're leaving safe yield on the table because the blunt instrument of the BDC regulation forces them to treat their safest loans exactly the same as their riskiest loans when calculating total fund leverage.
Exactly. I mean, that aligns with the core problem that JVs are designed to solve. The joint venture is the surgical solution to that blunt regulation.
So how does the Capstone JV actually bypass that?
MSDL partners with another massive institutional investor. They form a legally distinct entity, Capstone Lending, and they transfer a highly specific subset of those pristine first-line loans into that new vehicle.
Because Capstone is technically a separate entity.
Yes. So it operates outside the strict 2-to-1 regulatory cap of the main BDC structure.
Wow. And that allows them to apply targeted, asset-specific leverage.
Exactly. Management explicitly noted that the target leverage ratio inside the Capstone JV is between 1.7 and 1.8 times.
Okay.
They are borrowing slightly more against these specific assets than they do on the main fund, utilizing really cheap institutional bank financing to amplify the return.
Let me make sure I have this right. They take that incredibly safe asset yielding 8.7%.
Yep.
They apply 1.7 times leverage to it using cheap bank debt inside Capstone.
Right.
And the net cash flowing back to MSDL as equity distributions suddenly equates to an 11.2% yield.
The math is undeniable.
It is undeniable. But your earlier point, what about the risk profile? What is actually inside Capstone?
Management was highly transparent on this exact point. The assets inside the JV have 100% overlap with the assets on MSDL's regular book.
Oh, wow.
They are not venturing into second lien debt. They aren't touching unsecured tranches or doing speculative turnaround plays to generate that 11.2%.
They are using the exact same highly vetted first lien collateral they always use.
Precisely. They are simply structuring the liability side of the equation more aggressively on a ring-fenced subset of the portfolio.
Okay, that transparency completely mitigates my primary concern. If the underlying collateral is identical to the core book, the risk profile isn't mutating, it's just mathematically levered.
Right.
And the execution velocity on this is staggering. It operated for 5 weeks and dropped a full penny per share to the bottom line.
And they currently have a $383 million portfolio inside Capstone.
That's already massive.
And they mapped out a very aggressive glide path to scale this up to a $700 million target over the next 4 to 6 quarters.
And when you map out the earnings power of a fully scaled $700 million JV operating at an 11.2% yield, what does that look like?
Management anticipates it will add 2 to 3 cents of pure NII per share to the baseline.
When your baseline NII is 47 cents, layering in a structural, highly visible 3-cent growth engine over the next year is a massive strategic advantage.
It's huge.
It provides immense insulation for the 45-cent dividend against any future unexpected Fed rate cuts. It transitions MSDL from a defensive crouch right into an offensive posture.
That is a perfect segue into the third phase of our analysis, actually.
Guidance.
Yes, we have dissected the Q1 performance, validating the structural integrity of the balance sheet. But the market trades on the future. We must scrutinize management's forward guidance to understand how they are positioning this massive pool of capital for the remainder of 2026 and beyond.
And the most profound piece of guidance they delivered pertained to the shifting tectonic plates of the private credit market itself.
It was a huge statement.
We discussed spread widening earlier as an accounting detriment to the NAV.
Right, the paper losses.
But when management looks forward, that spread widening is the single most bullish signal in the entire earnings call. The era of yield compression appears to be dead.
CEO Michael Ossie framed this with some pretty stark historical context.
Yeah, he pointed out that Q1 of 2026 marked the first quarter in the last 8 consecutive quarters where MSDL did not experience yield compression on new deal origination.
Let's translate the gravity of that for the listener.
For 2 straight years, 24 months of relentless grinding, every time MSDL went to the market to underwrite a new loan, they faced a wall of competing capital.
So much dry powder sloshing around.
Exactly. There was so much money in private equity and private credit that the borrowers basically dictated all the terms. They could demand lower interest rates, shrinking the spread lenders could charge.
The returns were being steadily compressed by sheer capital gluttony. Too much money chasing too few premium deals.
Right, which forces lenders to either accept lower returns or just walk away entirely.
But Ossie declared that the tide fundamentally turned in Q1. They witnessed spreads widen, meaning lenders could finally charge a higher risk premium by approximately 25 basis points across the market.
And it wasn't a one-off anomaly. Co-president Jeff Day stepped in and confirmed that the momentum has accelerated.
Right. He noted that early data from Q2 shows economics moving an incremental 25 basis points or more in the lender's favor.
A 50 basis point swing in underwriting spreads over a 6-month period. That drastically alters the return profile of the new vintages MSDL is building today.
The loans they write in 2026 will be structurally more profitable than the loans they wrote in 2024.
But the interest rate is only half the battle. I would argue the more critical shift Jeff Day highlighted is the structural power dynamic regarding the actual loan documentation.
The rules of engagement are changing.
Yes. He specifically pointed out that new deals are being struck with tighter EBITDA definitions and a greater use of financial covenants.
This gets to the very heart of underwriting discipline, because during the euphoric peak of the private equity boom, borrowers and their sponsors became incredibly aggressive with EBITDA add-backs.
Oh, this is the dark art of corporate finance right here.
It really is.
Let me explain this. A company brings in $10 million in actual physical cash flow. But their private equity sponsor builds a spreadsheet that says, well, if we fully realize the synergies of this recent merger, and if we normalize this one-time supply chain disruption, and if we project next year's cost-cutting measures backward into today.
Our adjusted pro forma EBITDA is actually $15 million.
Exactly. And the sponsors aggressively demanded that lenders underwrite leverage based on that fictional $15 million figure, rather than the reality of the $10 million.
It artificially inflates the debt capacity of the borrower,
which drastically thins the margin of safety for the lender if those theoretical synergies never actually materialize.
So, by enforcing tighter EBITDA definitions, MSDL is wielding its newfound market power to reject the fiction.
They're telling borrowers they will only lend against tangible, verifiable cash flow.
That is a massive de-risking event for the portfolio.
It really is. You combine that with a greater use of financial covenants, which are the strict operational and financial tripwires a borrower must avoid to prevent default.
Right. And MSDL is constructing a heavily fortified portfolio. They are securing higher yields on fundamentally safer loans with tighter legal protections. It is the absolute definition of a lender-friendly environment.
Which begs the structural question, why now?
Yeah, why has the leverage swung so violently back to the lenders in early 2026?
The catalyst is the collision of higher for longer base rates with a looming maturity wall.
The maturity wall.
Massive tranches of corporate debt that were originated years ago during the zero interest rate phenomenon are suddenly coming due. These companies absolutely must refinance to survive.
The demand for capital is inelastic. They basically have a gun to their head.
Exactly. Meanwhile, on the supply side, the macroeconomic uncertainty of the last 2 years has shaken out the weaker, over-leveraged lenders.
Regional banks have pulled way back.
And marginal private credit funds are stuck managing legacy distress.
So you have desperate borrowers flooding the market right as the supply of disciplined capital shrinks.
It creates a massive supply-demand imbalance. And a fortress balance sheet player like MSDL gets to play kingmaker.
And they are wielding that power with extreme prejudice. Jeff Day revealed a statistic that perfectly encapsulates their posture.
What was it?
Over the trailing 12 months, MSDL closed on a mere 5% of the deals they originated.
Wait, 5%?
Just 5%?
That is an astonishing funnel metric. They evaluate 100 potential middle market loans, they run the diligence, they look at the EBITDA add backs, and they flat out reject 95 of them.
It proves they are not suffering from capital deployment pressure.
No kidding.
They are leveraging the immense sourcing engine of the broader Morgan Stanley investment banking platform. They see a massive swath of the deal flow in the market,
Which affords them the luxury of passing on anything that doesn't meet their pristine credit standards or offer premium economics.
That 5% close rate is the ultimate sleep well at night metric for a retail investor. They are prioritizing principal protection over aggressive asset growth.
But there is one specific vulnerability that management felt compelled to address extensively on the call. It's the single biggest narrative threat to the market right now: artificial intelligence. MSDL's portfolio is heavily concentrated in software companies.
Right. And the prevailing market thesis is that generative AI will just commoditize code generation, permanently impairing the business models of legacy software providers.
The fear is, if an AI agent can build an enterprise application in an afternoon for pennies, why pay millions for a massive, clunky legacy system?
That is the existential dread hanging over the tech sector. So how did MSDL's management quantify this risk within their specific loan book?
Well, they bypassed the philosophical debate and leaned into rigorous data analysis. Chief Investment Officer Ashwin Krishnan detailed their use of a proprietary AI scorecard.
An AI scorecard.
Yeah. They developed a quantitative framework to evaluate every single existing portfolio company and every prospective deal, specifically against the vector of near-term AI displacement risk.
I appreciate that they aren't just relying on gut feeling, they actually built a model. What did the scorecard output reveal about their exposure?
The results were remarkably defensive. They concluded that only a low single-digit percentage of their extensive software portfolio sits in the high-risk category for near-term AI disruption.
I am going to challenge that optimism.
I figured you might.
How can you have a portfolio dominated by software loans in 2026 and claim that almost none of it is threatened by the most disruptive technological leap since the internet? What makes their borrowers immune?
The immunity stems from the specific subsector of software they target. Krishnan emphasized that MSDL does not lend to consumer-facing apps or lightweight productivity tools that can be easily replicated.
Okay, so what do they lend to?
Their capital is heavily concentrated in mission-critical system of record platforms, characterized by massive switching costs.
Let's break down system of record for the listener.
Sure. Imagine a sprawling, multi-state hospital network. The software architecture that securely manages millions of patient medical histories, integrates with dozens of insurance providers for billing compliance, handles pharmaceutical tracking, and schedules thousands of doctors across hundreds of facilities. That is a system of record.
It is the central nervous system of the entire enterprise.
Exactly. Now, conceptualize the sheer operational terror of attempting to rip that system out to replace it with a cheaper, newly generated AI alternative.
The risk of catastrophic data loss during migration.
Paralyzing downtime.
The immense cost of retraining tens of thousands of healthcare workers on a new interface.
The regulatory nightmares if a single patient record is corrupted.
The disruption to the core business would be fatal.
And that friction is what constitutes high switching costs. Even if a fundamentally superior AI-native alternative exists, the organizational pain of executing the switch is so agonizingly high that the hospital simply accepts the status quo, renews the contract, and keeps paying their recurring subscription fee to the legacy provider.
The legacy software company effectively holds the enterprise hostage through operational entanglement.
Yep. And that dynamic generates incredibly sticky, highly predictable, recurring cash flow. And as a private credit lender, highly predictable cash flow is the only thing you care about.
Krishnan even presented a counter-narrative, actually, suggesting that AI might serve as a powerful tailwind for these entrenched borrowers.
Wait, how does AI benefit the legacy dinosaur?
Because the legacy system of record possesses the most valuable commodity in the AI era, proprietary data.
Oh, of course.
These established software companies have decades of deeply integrated customer data sets. They can bolt language models and AI agents onto their existing platforms, instantly delivering enhanced analytical tools to their captive audience.
Thereby deepening the entrenchment and further raising those switching costs.
Exactly. They have the distribution channel that the startups completely lack.
So management views the AI threat as localized and highly contained by structural moats.
They do.
They view the macroeconomic lending environment as shifting violently in their favor, offering wider spreads and stronger covenants.
Yes.
So taking all of this guidance into account, where does management set the expectation for the baseline performance of the firm moving forward?
They provided absolute clarity on the earnings floor. Having absorbed the impact of the December Fed cut, they view this quarter's 47 cents of net investment income as the new stabilized baseline run rate.
Assuming base rates remain relatively flat from here, which is the current market consensus.
Correct. But critically, that 47-cent baseline represents the organic earning power before the Capstone JV fully scales.
Right. As we mapped out earlier, they have a high confidence trajectory to add an additional 2 to 3 cents of NII per share from that vehicle over the next year.
Which points to a forward earnings power of roughly 50 cents per share, providing a massive expanding buffer over their 45-cent declared dividend.
It illustrates a highly defensive posture that still possesses engineered upside.
It really does.
Well, we have covered an immense amount of ground today. We analyzed the mathematical realities of floating rate mechanics, dissected the accounting nuances of spread-driven NAV declines.
We explored the accretive physics of share repurchases,
Stress-tested off-balance sheet leverage in the Capstone JV, and mapped the shifting power dynamics of the global private credit market. Now, we must synthesize this mountain of data into a coherent verdict for the retail investor listening.
The fundamental task here is to separate the transient noise of market sentiment from the compounding reality of MSDL's cash flow engine.
And when we strip away the noise, the bottom line is clear. Based on this Q1 2026 data, MSDL is flashing a definitively bullish signal, specifically tailored for the long-term income-focused investor.
The thesis is structurally sound. A superficial reading of the headline numbers, shrinking top-line income and a 45-cent hit to net asset value might induce panic.
It definitely would.
But our analysis proves the foundation is rock solid. The income drop was a mechanical reaction to a known Fed policy shift, wholly offset by their own liability management.
And the NAV decline was predominantly a paper illusion driven by market risk premiums, not borrower distress.
Right. The ultimate proof of life for a BDC is the non-accrual rate. In an environment engineered to break weak companies, MSDL's non-accruals actually contracted to an elite 1.5%.
They're managing the credit risk flawlessly.
Furthermore, they are aggressively playing offense. The era of compressed yields is over. They are demanding and receiving wider spreads and tighter covenants on new deals.
And they are leveraging the Morgan Stanley machine to cherry pick only the top 5% of the market.
The 45-cent dividend is not just safe, it is fortified.
They established a 104% coverage ratio at the absolute bottom of the rate cut cycle. And they have the Capstone JV actively scaling to deliver a 2 to 3 cent structural boost to future earnings.
You are looking at a fortress balance sheet managed by a team that isn't afraid to cannibalize their own stock at a discount to create immediate value for shareholders.
For a retail investor seeking reliable double-digit yield with heavy downside protection, MSDL is executing the playbook perfectly.
It is a masterclass in cycle management.
However, before we close the book on this deep dive, I want to leave you, the listener, with one final provocative thought to chew on. We spend a lot of time analyzing the immediate quarter, but true wealth preservation requires looking 3 years over the horizon.
The long tail risk.
Precisely. We dedicated significant time to management's defense of their massive software portfolio against the AI threat. The entire premise of their confidence rests on 2 words: switching costs.
The organizational agony of ripping out a legacy system of record.
Exactly. It is a brilliant, historically proven thesis.
It has been the impenetrable moat of enterprise software for 40 years.
But history is not always a reliable guide during exponential technological shifts. AI capabilities are advancing at a pace that breaks traditional linear forecasting.
We are already witnessing the deployment of autonomous AI agents capable of reading millions of lines of legacy code,
Mapping complex, unstructured databases, and automating the most tedious aspects of IT migration.
They are attacking the friction itself.
If the barrier to migrating data and replicating workflows plummets toward zero, how long will those high switching costs actually provide cover?
That's a great question.
If an AI system can seamlessly, perfectly, and securely migrate that sprawling hospital network to a vastly superior 90% cheaper platform over a long weekend, without a human engineer ever touching a keyboard, do those switching costs simply evaporate?
It introduces a terrifying localized risk. MSDL's underwriting is immaculate today, but if the fundamental physics of enterprise software migration change, the definition of a safe first lane loan changes right along with it.
It is the one structural vulnerability that a long-term investor must monitor obsessively. MSDLs have proven they are the apex predators of the current private credit ecosystem. But the ecosystem itself is evolving faster than ever. Weigh that against the immense current yield as you structure your portfolio. Until next time.